Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show. Thank you everyone for spending some of your weekend with us, whether you're listening on the radio, on our website, podcast, or YouTube channel. Please be sure to hit like, subscribe, and share your comments with us on whatever medium you are listening to our show. This weekend show is focused exclusively on investing in commodities sectors, especially the commodities equities. In the first half of the show, we're going to be going around the horn with gold stocks, silver stocks, copper stocks, oil and uranium stocks, seeing what opportunities lie within those. And then the back half of the show, more of a focus in the energy sector, mostly up in Canada. Starting off with Sean Brodrick. Sean is the editor of Wealth Megatrends and Resource Trader, also contributing analyst to Weiss Ratings Daily. Look, Sean, as I said, let's focus on the equities, the commodity equities. Let's start off with gold stocks, because gold above $3,000 as we're recording this, GDX, GDXJ, those major ETFs with the gold stocks, those have also been breaking out to some very significant highs. Look, I've been on record saying, at least for the last 6 to 12 months, that this is the best market I have seen for especially gold stocks. The big stocks are performing well, the mid caps are doing well, and many juniors are also doing well. So, Sean, let's start off with the producers. What are you seeing in terms of gold producers, those equities, the opportunities there, please?
Yeah, well, most of them have had a good run. Now, we have seen gold start to go sideways, probably because everything's calming down ahead of the big tariff announcement on April 2nd. And so we've started to see some of these equities pull back. So now I'm going to look for opportunities to add two positions in like existing positions we have, which are doing extraordinarily well, like say Helios Star Metals, for example. That's just rip roaring. That's doing fantastic. Equinox, even though their merger with Calibre might be in trouble, it still looks very good. Calibre, their like major shareholder, came forward and said, we don't like the deal with Equinox, and so we don't want that. We're going to see how the shareholders vote. If the shareholders vote not to make the deal, I actually like Calibre as an independent company. I think it looks fantastic. So, we own that in like one of my special reports. I was expecting it to go away and be absorbed into Equinox. Maybe not. Maybe we get to hang on to that. Large companies. Agnico Eagle is just one of the best miners around, period. It's fantastic. It's doing great stuff for us. And so I think that you just should definitely be owning that one. And, large companies, which I had written off a long time ago, like, say, Newmont and even Barrick, Sadsack Barrett, they are looking good again. They are looking strong. And like I thought, the people at Barrick, they just had things so wrong. And then late last year, things started to click for that company, and it's just been on a rampage since the end of December. The thing's just been going higher. It's making higher highs and higher lows, which is what you want to see in anything. Things never go in a straight line. You want to see them zigzag higher. So even though I don't own Barrick now, on the next pullback, if and when we get one, maybe I'll add it. That's at least a few to work with.
Yeah, Sean, all great names there. And it's kind of been exciting to see the sector getting some traction, pulling in some bigger volumes finally. There was no volume in most of these stocks, and now starting to see an uptick in that. And when you look at Q1, we're almost done with it here. We've had the highest gold price and average price for the quarter that we've ever seen. We've had a pretty good response to the Q4 earnings. The Q3 ones were kind of a stinker, but the Q4, pretty good response in most of the big producers and the mid caps. With Q1 having record high prices, do you think you'll see even more analyst coverage where it's just making too much money, the margins are too big to ignore?
Oh, yeah, I think so. And it's amazing, like what some of these companies have done. Take SSR Mining, for example, which is another one of our positions. I mean, its earnings are forecast to grow 411% this year. Now, if a tech company does that, Wall Street goes bananas, says, oh, that's fantastic. That's great. A gold company does that, and it gets like no coverage. Now, the people who are buying it know the thing's up very nicely. It's up like 170% off its 52-week low. But it's still amazing to me how little coverage this gets in the broad media. When will that happen? You know, that is a good question. I had a price target on gold of $3,000 by the middle of this year. We seem to have gotten there early. Part of that might be because of the tariffs, because in anticipation of tariffs, there were big imports into the US, and combined with the central bank buying and all the other bullish things that were going on for gold, that seemed to give gold a little bit of juice right there. So maybe we'll see a pullback for a bit and then we'll take off. But where's the next top? I mean, there is some overhead resistance at 3,100. Would that be it? I don't think so. I think that the next leg is just going to be a good long one. Of course, I have told you guys that longer term, I have a multi-year target on gold of more than $6,000 an ounce. And I think we're going to get there. The move we've seen has been fantastic, but it just can be so much more because I'm old enough to have been around for multiple bull markets in gold. And when this stuff runs, it can really run. And when gold runs, the gold miners, like the ones that I've talked about here today, they just go ballistic. Now, of course, history doesn't have to repeat. There can be a lot of things that change and all that stuff. But I mean, it's the hard lessons of long experience that just tell me what's going to happen here. And you really want to be in the precious metal sector when this stuff happens, gold and silver too.
Well, the one thing that's clear is that there's a whole lot of indecision around the world right now. Trade wars seem to be ramping up. Everybody waits for the turn of the month to see what tariffs are coming in place. And we keep hearing from companies that they're handcuffed. They don't know what to do because they don't have any clarity on what direction these trade wars are going. And clearly that's all helping the precious metals, gold especially, in terms of the production stocks. Then yes, their earnings are knocking it out of the park simply because the product they're selling keeps going up in price. Gold has been up 10 out of the last 13 months. GDX has been up 10 out of the last 13 months. But Sean, in terms of individual companies, any stocks that you have on your radar that either you own or you're watching that have production growth, anything that adds that extra torque to these higher metals prices?
Well, Equinox certainly does. IAMGOLD, that's in another one of my portfolios. That's going to have production growth this year. In my personal portfolio, I have Discovery Silver. And even though it's called Discovery Silver, well, they actually picked up the Porcupine mine from Newmont. And so now they're a gold miner. That's how these things go. And they're going to have great growth. They're going to be fantastic. That Heliostar as well. Heliostar is growing big time. If you want to look at silver, one of the we have in that portfolio, which is under the water right now because we bought it a while ago, but they have earnings coming out soon, and I think it's going to be fantastic. That's Aya Gold and Silver. They mine in Morocco. They have a fantastic silver mine there. They had some problems last quarter because their production didn't meet expectations. But, I mean, the thing about mining is if anything can go wrong, it will go wrong. And, it's an up and down business. You have bad quarters, you have good quarters. Well, they had their bad quarter. I don't think the next one will be bad. The people running that mine are smart. So, that might be a dark horse that people might want to look at. Don't take any of this as investment advice, by the way. I'm just telling you what I already have in my portfolios. And so I thought they were good ideas at the time. I'm being proven right on a lot of these things, but we don't know how things will go. So this is not investment advice, but I like all the names that I'm talking about here.
Well, Sean, you bring up a couple interesting names because with Discovery Silver, a silver company that's optionality play on higher prices, buying the Newmont assets, the Porcupine Mine Complex, all those gold mines and gold development projects, you see a junior becoming a producer With Heliostar, we saw the same thing. They had some exploration projects in Alaska and Mexico. Then they suddenly buy producing assets in Mexico, and they have a development project that they're going to try to bootstrap with the producing assets. Is this a trend we're going to see more of with the gold and silver companies, juniors that decide, hey, what the heck? The metals prices are big enough. I'm going to jump in the ring, put my producer hat on.
I hope so, because those are the kind of companies that I like to buy, because you can usually buy them before Wall Street as a whole actually finds out about them. I mean, certainly the people who are specialists in like this kind of thing will know, but you can get in ahead of the crowd. And I think that we're at that, let's say, that phase of the market where probably companies will want to focus on the assets they know will make them money. So we'll see the big boys like Newmont spin off non-core assets. That's what happened with Porcupine. They had too many other good things to like focus on. That was too small of a project for them to actually deal with, which is fine, because for a small company like Discovery, it's actually a great asset. It's something that they can focus on, they can bring forward, they can really add value to it. So yeah, I expect to see more of this, and it's just going to be a lot of fun. This is when you want to be in the gold mining markets. Oftentimes it's miserable, nothing's going on, it's just crazy. But now things are starting to pick up, and we still haven't seen much movement. That's the crazy thing. I mean, I was talking about SSR mining being up a lot. A lot of these things haven't moved that much. They really haven't. And so their times to move are in the future, and it's going to be a lot of fun.
Oh, Sean, yeah, we'll see. I have seen a lot of these stocks move, in all fairness. Even the GDX is up 71% just in 13 months. So we have seen some of these stocks really get going. One sector of stocks, though, that I think has been still lagging is a lot of these silver stocks. You even mentioned a couple stocks there that were silver names that moved over to the gold sector on the production front. There's a number of small silver miners that, quite frankly, when I look at their earnings, they're still not making the money that I thought they would at these much higher silver prices. Are you moving into silver stocks as well for either a catch-up trade or simply to maybe make some money at this almost $35 an ounce silver price?
I find that the silver mining world is split starkly between those companies I want to own a lot and those I don't want to own at all. And I hate to give any names out, because that's probably the stuff that I'm going to recommend to my subscribers on the next pullback for that whole catch-up thing you were just like speaking about, because they haven't performed as well. That's actually what I was referring to there, because it's very hard to find pure silver miners. They always have at least a little gold, or they have some other byproduct. But I do have some companies on my radar on the next pullback. That's probably the stuff I'm buying, is like either silver miners or developers, which have just extraordinary potential here.
Yeah, it's exciting to follow the silver space. There really is a story of the haves and have-nots, because just like the gold stocks, I've seen a lot of silver stocks that have moved. There's a lot that are up 100 to 200%, so I'd say that's a good move. SILJ has been moving, and it's finally starting to catch up a little bit on the gold stock. So we'll keep tabs on the silver stocks, of course. But boy, another commodity that's also breaking out to new all-time highs just this week is copper. We've talked a lot about copper and the fundamentals for it on the show for a long time. But when any commodity goes up and makes a new all-time high, like it just has this week, up in the 520s, even got up to like 537 just earlier in the trading yesterday. And we're recording this on a Wednesday. But man, copper has been moving, but the copper stocks have had a more muted run. Are you looking for that same kind of catch-up trade in the copper equities?
Well, yeah, I mean, some stuff doesn't really make sense to me. Like Hudbay Minerals should be up more than it is. I mean, what's going on there? Teck Resources, I mean, they've really been making some progress. I know that their earnings don't look so good this year, but still, with a high copper price, they should do better, right? I don't own either of those stocks, by the way, so you can take that any way you want, and you can look at the larger ones. Freeport is also one of the world's biggest gold producers, right? So, but it is a copper company, and it's only like 22% off its lows. So, yeah, part of what's going on there is I think people are worried what's going on with copper, and they might be right. A lot of it has to do with the tariff. So once the tariffs are in place, are we going to see copper prices calm down? Now, I think that would be a pullback that could be bought. Maybe that's when you want to get into these names, is on the next pullback. Like, we've had this great run in copper. It looks like it might be peaking now. I don't know. On like April 2nd, when we see the copper tariffs roll out, because that's one of the things Trump said that he wanted to target, was he wanted to put new copper tariffs on. Once we see what they are and companies adjust, then maybe that's when you want to buy these stocks if they pull back then. Or else maybe they'll take off. Maybe I'm an idiot for not owning them now. That could be too.
Sean, it was earlier this week that I had a guy from a commodities trading desk on the show, and he actually pointed out the spread, the differential between COMEX over the LME price, which I believe was 70 to 80 cents. And he actually said that a lot of the copper stocks more following that LME price, which who knows what that all means, but that clearly is tariff related. But on the back of that tariff related news, do you like any of the copper stocks with U.S. projects then, if the U.S. truly is going to focus on trying to build up some domestic production?
I don't know. I mean, certainly what we've heard from the White House is they are going to clear all the roadblocks from like U.S. mines, right? So if you want to build a mine in the U.S., it's going to be free and easy. You can just do whatever you want. Now, it's still going to be a slow process to build a mine. I'm not sure a lot of people realize that even if the government wasn't standing in your way, it would still take years to build a mine. But that certainly makes it more attractive. I think having all the red tape lifted, makes these stocks look better. I'm not sure what to actually recommend in that case. I'd still like to see some kind of new regulations roll out. They aren't going to completely get rid of all regulations. What are the new regulations going to look like? I'd love to see that, but that should certainly help those stocks. Yes, U.S. producers.
Well, and another big news event that dropped this week from the Trump administration was they put out an executive order, the immediate measures to increase American mineral production. And it really is focused more on critical minerals, but they lumped all kinds of different commodities into this. Things like gold were considered critical. Strangely enough, copper wasn't on this list, but they had things in there like potash, uranium. There's just a lot of different incentives now to not only take away some of the regulation hurdles, but also funding options, increasing the permitting timelines. And some of these things have an urgency factor, like in 10 days they have to do XYZ, and in 30 days they have to do this. What do you think that means for the commodity sector overall in the U.S., not just copper, but gold, uranium, fertilizers, all of it?
Well, if we have more production, prices should go down, right? I mean, but it's a long way between announcing these things and actually getting things done. So maybe the excitement will lift these stocks in the meantime. And as stocks come into production, then their prices should go up, even if the general price of things actually goes down. I mean, fertilizer is an important one. And I know they don't want to be so dependent on like foreign sources of like all kinds of fertilizer. So I think that's something they would proceed with. I really don't follow that space, but there's some real potential there. Again, it's still early days though. What are they going to do? They actually say they want to do these things, but what are the actual regulations going to look like? That's what I'd love to see.
I agree with you. That's always the big question. And then the other question I have is, will this free up capital? Because yes, shortening permitting times and even handing out permits, that does help companies on the share price side, and that can lower the cost of capital. But we need more money coming into these development plays to actually help build these assets. Do you see a change happening here where money will start to fund these companies?
Well, we need to get the younger generation to stop throwing their money at cryptocurrencies and start funding mining projects. I mean, that's what happened to a lot of it. That's why at least some money dried up for the mining industry, was like the younger investors said, no, I'd much rather go play with electronic money. That looks much more interesting. And so I would like to see that happen. I'd like to see more funds come into this. And for the health of the nation, it's really important that we get more funding for these things. I mean, we need to develop these projects, but I don't have a crystal ball, so I don't know what's going to happen there.
Well, another interesting thing that's in this executive order is there is an initiative in there for the Secretary of Defense and the National Security Capital Forum and the Department of Defense to get in there and try to pair up private capital with commercially viable domestic mineral production projects. So they're basically trying to play matchmaker as a government, and they say that there's funds available in here that they're going to apply towards the mining sector. So we'll just have to follow along. Sean, they do name uranium in there, and that's a commodity we wanted to get to here on this weekend show. Uranium's been in kind of a mess most of this year. It's been in a mess really since the halfway through last year. So the second half of 2024, all the way into this year, it's been in the hurt locker. And now there's a little bit more focus on it, but it doesn't seem to be lifting the stocks that much. They had a little pop, but then another drop. How are you looking at uranium and, more importantly, uranium equities?
Well, perhaps uranium investors have the same fear I do, which is that since things seem to be warming up between the U.S. and Russia, we might lift a ban on imports of uranium and uranium fuel from Russia, and they might remove their ban on exports to us. And if that happens, then we'll have cheap Russian fuel coming into the U.S. Now, I would certainly love to see more U.S. mines developed. And certainly, if the U.S. is worried about national security, then they want uranium mines. That just makes common sense. But I'm not sure how it will work out. That's a industry that I'm kind of avoiding now just because playing in gold is so much fun. Might as well go where you're having fun. And I'm having a lot of fun in precious metals right now. So that's what I'm really doing. I like the concept of uranium. I don't know what the impact of our warming relationship with Russia will be. So I'd like to see how that plays out before I start going back into uranium stocks again.
Sean, I think that's so important to understand that you're not alone in that feeling, right? You are a resource investor. You like putting money to play in commodity stocks, but quite frankly, when a sector, one of the biggest sectors like gold in the commodity sector is running, then you get focused there. It's no different than other people getting focused in a tech sector. Is the fact of the matter is when gold is consuming a lot of this money, sometimes you just need to ride that wave rather than try to fight it.
Yeah, I agree.
So, Sean, are you avoiding all uranium stocks then? Or are you trying to pick the bottom in any of them?
Well, I have two, and I had a lot more, but I'm not trying to pick a bottom at this time. No, I'm keeping an eye on Cameco, seeing what happens with that, because so much money has been chased out of the sector. That's where you'll start to see money flow back in first, I think. I can think of some other great U.S.-focused uranium companies that should be doing better than they are, and they aren't. Maybe if UEC starts to come back, maybe if UR Energy starts to really make some traction, that'll be great. There is so much potential in these small companies. And yet at this time, as you were just saying, I think that they're kind of getting squeezed out because it's so much fun being in like other industries.
Well, one more commodity sector that will squeeze in here, focused on energy as well, is oil and nat gas stocks, traditional energy. It's the same kind of thing. Nat gas has had a big rip. Some of those companies have gotten some traction. Oil has been rather muted, though, stuck between 65 and 70, kind of in a range. And yet the oil stocks have had a bounce recently. How are you looking at things like traditional energy?
Oh, more than a bounce. My like Chevron and my Devon Energy, they're doing great. And there's a whole bunch of energy names that I've been looking at recently. Now, they seem to be peaking today. You and I are speaking on Wednesday, but nothing travels in a straight line. When they pull back, that'll give me an opportunity to buy them because I didn't buy them earlier. And that's EQT, EXE, AR, RRC, CTRA. These are the symbols that I'm looking at. I'm also looking at Schlumberger, which just peaked today again. So it's going to pull back, but man, does that thing look like it wants to break out of a long-term base. So, I think there's just so much potential there. And yet, this is the thing that is driving me crazy. I've seen international agency after international agency coming out and saying we're going to have a surplus of oil this year, right? So maybe, but that's not how oil is acting. Oil is acting like it's worried that the U.S. and Israel are about to bomb Iran. And maybe they are. We've seen some like bombers move to that small island they have out in the middle of nowhere, and stuff like that. Maybe they are. But what's going to go on with Russian oil exports? Since peace seems to be breaking out in Ukraine, does that mean that Europe is going to start buying Russian oil and especially natural gas again? I'm not sure if they are. There's a lot of, I guess we're going to have to use the word uncertainty again. There's a lot of uncertainty in this market that I can't really figure out why things are going the way they are. I like the action in the stocks, though, and maybe that's leading the price in the commodities. So maybe on the next pullback, those are the things that I'll be buying.
Yeah, that's the other thing that I've noticed too is that the energy stocks are doing great. Some of those ETFs are right at all-time highs. They're very near them while oil has continued to struggle and natural gas has done pretty well. Although that's pulled back a little bit too. But again, lots of opportunities in commodity stocks. The first quarter of this year has been very good for investors. Really just seems you need to be in some of the bigger names too to take advantage of these moves, but that money definitely has started to continue to trickle down, not just the mid tiers, but now also into some of the smaller companies. Sean, it's great having you on the show, and thank you very much for sharing a number of company names for our listeners to watch out for. Again, Sean Brodrick is the editor of Wealth Megatrends and Resource Trader, also the contributing analyst to Weiss Ratings Daily. Sean, great chatting with you. Thanks for taking time on this weekend show, and everyone, stick around. We're going to be right back with even more of a focus in the oil and natural gas sector.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we're now moving exclusively over to the energy sector, chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report. Also writes the Ion Energy Report, which is a free report, more just outlining the fundamental drivers, the data around the oil and natural gas sector. That Schachter Energy Report is where Josef dives into a wide range of energy companies, sharing his thoughts and when he thinks a good time to buy is. Now, Josef, let's start, as we always do, higher level on natural gas and oil, starting off with natural gas. The price is a little bit off its highs right now, trading about 388 in around that region. Again, it was up in the 450 region not that long ago. I keep hearing about storage levels, these being a key driver and how storage levels are below, about 10% below the 5-year average. And supply has been generally slower to come back online in this higher natural gas price environment. We hardly saw over $3 last year, and now it's held above $4 for quite a bit of this year. Josef, give us some clarity here on where you see the natural gas price moving.
Yeah, we've backed off a little bit, and that's because the EIA report that came out last Thursday showed a build. Normally, March is still a draw season, and then April 1st is the beginning of the injection season, and then that goes till November, and then November starts the withdrawal season again for the winter. So we had a 9 BCF increase last week. South Central had 28 BCF increase, while the East was still cold and had a 12 BCF draw. So, that kind of spooked the markets, and from 430, you came back down to the 380s. But the positive for the industry is record LNG exports. The data from last week, 15.7 BCF. That's the highest number ever. And remember, 10 years ago, there was nothing on the LNG business. So that's quite a thing. And when 10 years ago, Canada and the States were both talking about it. Canada's not going to get our first one until, July on stream. And the Yanks have, 15.7 BCF exporting. So that's why we're still in these high threes. And again, this summer, you'll be having air conditioning demand, more data center demand, where natural gas is used as the fuel. So I think we're looking at, a 350 on the bottom now, over the next number of months at the low, but I think 450 on the high. And then winter of 2025, 26, we'll see if we punch above $5 if we have cold weather and big and more exports of LNG with the additional plants coming on. As you mentioned earlier, the comparison storage now is 10% below 5 years ago, but more importantly, it's down 26.8% from last year. So this big drawdown really woke everybody up to the fact that, yes, storage is important, but weather is even more important. And the cold weather we had this winter really drew down stocks in the United States, significantly in Europe, shocked everybody. That's why they were buying cargoes from Asia at $15. Shipments that were heading to Asia to get $13 US were now being moved over to go to Europe for $15 to $17. I think 17, 18 was the high per MCF US dollars in demand in Germany, especially where storage got drawn down very quickly.
Well, Joseph, just in light of how natural gas is really more of a regional market, like you're saying, like different countries are paying totally different amounts. And even inside of the US or inside of Canada, there's different amounts that are based on the West Coast and East Coast where the different fields are. Do you think that we start seeing a normalization of nat gas prices as more LNG terminals are built, not just in the US, but also in Canada, and more of this starts shipping around? Will it lift domestic North American prices up to a more stable level? And will some of the Asian and European markets come back down? Will there be some kind of equilibrium is what I'm getting at?
I think Asia and Europe are separate issues because, they need LNG. There's a cost for LNG to liquefy it, ship it, and then move it into a gas format again. So there's going to always be a big price difference between that and the producing nations like the United States and Canada. So, and Europe, of course, because they used to buy from Russia, unless Russia and Ukraine solve their problems and there's a peace deal that's sustainable, you won't be, Trump's already waving the flag saying that we'd open up Nord Stream 1 if Russia signs a peace deal and they finalize everything and both sides, say, yeah, well, this is the deal and this is the land concessions and the fighting stops. So, I think in the US, we're looking at more LNG capacity coming on. In Canada, the big thing is our LNG Canada project, train 1, will take 1 BCF this summer, a total of 2 BCF by the end of the year. But this summer, with all the positive that Shell's been talking about the natural gas demand for, around the world into the, 2040, they're talking, I think, a 60% increase in demand for natural gas. I think LNG Canada will be announcing train 2, and that plus Cedars, I think, will help to tighten it. We're about 2.25 right now for AECO in Canada, which is a lot better than this time of year. You might see $1.50 or $1 even. So we're a little stronger. LNG Canada comes on, that keeps us in a $2 range. And then the end of the year, I think we can move into the threes. And then I think into 2026, we could be within a $2.50 on the bottom and a $4 on the top. Prices in Eastern Canada are higher because you have to add in transportation. So the Dawn market is always higher than the AECO market. But AECO and Station 2 will improve once we see LNG Canada 1 on and the announcement of LNG Canada 2.
Okay, so overall, you're seeing just a positive environment for natural gas. Sounds maybe even a little less volatile, but at least the downside being limited. What about oil? Oil seems to be a completely different market. The about $65 a barrel region is held for years here, but we're consistently seeing lower highs. We're getting this tightening pennant formation where if $65 breaks, who knows where that bottom could be. So are you worried that we could see a breakdown below $65 a barrel?
My work says, 64, 65 is the bottom. You always have to have a little room on these charts, especially the deeper they go down, with that technical pattern. You get lower lows and you get lower highs, until it breaks one way or the other. I think we're going to break to the upside this summer for two reasons. One, summer demand is about 1 million barrels plus higher than we are today. So even with tariffs, you're going to see a demand increase in domestic market areas. We may not see as much use of diesel for shipping, international shipping, but more domestic demand, as we see local economies, decide how they're going to solve the tariff problem with exports to the States. Second, I think geopolitical risk is coming back this summer. You've already got the United States regularly knocking out Houthi, armaments and Houthi leadership and command and control so that they stop their attacks on shipping in the Red Sea. The cost of shipping by going around the Horn is very expensive. So they would like to see the Red Sea reopen for commercial shipping. Every week there's attacks on American destroyers in the Red Sea. So they've sent in a carrier group as well, and they're just knocking the hell out of the Houthi military infrastructure. And they're moving 2 more carrier groups into the area because they want to have capacity for Iran. Iran is within weeks of potentially getting sufficient nuclear material, weapons grade material, for up to a dozen, some of the reports are saying, of intercontinental ballistic missiles. The Israelis, of course, aren't going to want to see that happen. The US is not going to want to see that happen. So we're getting to the 11th hour where something has to give. Either the Iranians say, okay, we will agree to, demilitarize and give up our nuclear weapons program in return for sanction relief. So because their economy's in tatters and the mullahs are out of favor with the population. So that's a positive potentially. And so I think that if the Iranians do not come to the table, we could be looking at some military confrontation between America and Iran, or America and Israel and Iran. That's good for a $10 pop in the price of crude almost overnight.
Okay, Joseph. So even though we've been trending in the $65 to $70 range, you see a case for $80, tacking on another $10 to the price. When you look at the oil stocks, despite the muted price moves in the underlying commodity, they've actually been pretty strong. We were looking at XLE, it's up, knocking on higher levels again. A lot of the individual oil stocks have jumped up double digits. So what do you make of the divergence between where the energy stocks are going, even in a kind of a lackluster oil market?
Yeah, I think the key is when we're seeing the Q4 2024 results and the outlooks for 2025, companies are talking shareholder returns. They're not talking about growth. They're not talking about spending more than cash flow. Many companies are trying to spend 50, 60% of cash flow to keep steady production, and the remainder being used. If there's a debt problem, pay down that debt. And if it's not a debt problem, then some growth, but half to 3/4 of what they call free funds flow, or free cash flow that's not needed to keep the business on a sustainable, steady pace, then they're using the excess for shareholder returns. And some focus more on dividends, some focus more on their NCIB, normal course issuer bid, stock buybacks. Some of the best companies are doing both, and the market loves that.
So what do you think it'll take for these companies to focus a little bit more on growth? Obviously, higher prices help, but what about those blended companies that also have that natural gas production? I'm just not seeing a whole lot of supply coming online as quickly as maybe you would expect in this higher price environment.
No, not really. But, you look at the Baker Hughes drilling stats from, last week, Friday, the Canadian rig count's at 180 now. It's normally low, goes down quite a bit now because of spring breakup, but that's still 6.5% above a year ago. And when you go down between gas and oil, the gas rig count is 61 versus 78 a year ago, down 22%. But the oil rig count, again, because the ability to export through the TMX, and also there's still capacity on the Enbridge lines, is at 118 rigs versus 91, up 29.6%. So if you have capacity to move product, you're seeing the increase, while natural gas really needs that 2 BCF of export capacity on LNG Canada to really make a difference in the activity for people drilling directly for gas.
Well, Joseph, just to that point, when you look at U.S. gas-focused companies, they've had a good response because gas is up near $4. But when you look at the Canadian companies, they've not had as big of a move because the AECO price is around $2.50. Because you see that being constructive, where it could get up to $3.50, and maybe even $4 by next year. How are you looking at Canadian nat gas companies?
Well, Canadian nat gas companies that have liquids, condensate and other liquids, have been very strong, 20% rise in things like New Vista. Peyto's had a good run. Paramount's had a good run. You've seen, Tourmaline have a good run. So you're seeing some big moves in those names which have liquids. Some of the ones that are dry gas take a name that you guys are familiar with, Pine Cliff, the stock is near their 52-week lows. So you need that liquids component to be significant for the market to give you some juice and upside in terms of people buying it. Other companies, like the more dry gas guys, are just saying, look, let's be steady Eddie, let's pay down some debt, continue to pay our dividends, and build up a nice drilling inventory when gas prices are higher.
Have you noticed the market rewarding market cap size companies, either large or small, probably the bigger ones? Is the market more favorable right now to a certain size of energy company in Canada?
The key thing is liquidity. So you look at CNQ, it was trading around 40, it's up 10%, 44.76. So you look at Synovus trading at 20.37. That's not really moved at all. The high for the year 29.96, low 17.43. So Synovus hasn't woken up from its deathbed. Baytex really hasn't moved. So there's some stocks that really are asleep, while others have had a good bounce. So I think it matters on the market. When investors come and want to get into the sector, they look at Suncor, which is 55.55, just $3 off its 52-week high. The low is 48, so they go there. They look at Imperial, they look at CNQ, and so they go where there's liquidity, so that if there's a decision, oops, I'm wrong, they can get out pretty quickly.
Joseph, what do you think the environment's like for M&A deals right now with oil prices where they are, where nat gas prices they are? Is there incentive? Is it a buyer's market or a seller's market? Do you expect to see more transactions?
Well, we saw Paramount sell at a very good price, $3.3 billion to Ovintiv, if you remember that big sale. And, now they're going to, grow with the assets they have and build another big company out of it. So that's positive. There's everybody on the gas side. If you have assets in Northwest Alberta, Northeast BC, you're not going to want to sell now, before the LNG business becomes material. So I would stay with the names on weakness. If I'm right that there's a little bit of weakness in the near term, keep on building your positions. If you recall, a month ago when you and I were talking, I was saying we're in a fabulous buying opportunity. Stocks are very cheap. You can get in great 8, 9, 10% yields in growth story names, both on the oil and the natural gas liquids kinds of stories. And we've had a great bounce, 20% in 3 weeks. But could we back and fill here if we back off $3, $4? Yes. So if the war premium shrinks and we're in the shoulder season until the summer driving season, that's June, the end of June, not April, not March. So I think there's a window here for one more pullback. But the approach I would be taking is buy the dip and add to your business.
I just find it so interesting. You look at these large sector-specific ETFs, the energy ETFs, and as we said, they're doing very well. If some of these ETFs bounce not even a percent from this level and close the month a percent higher from where they're at, it'd be the highest monthly close ever, all-time high monthly close. It seems like investors are still closely watching this energy sector. Why do you think that is, Joseph? Has there just been a broad shift more to maybe a interest in commodities from investors?
Number one, I think there is more interest. Look at copper, record new highs on the nominal for two reasons. One, of course, the tariffs issue. And the second, Chile is having problems producing, and it's one of the biggest producers of copper in the world. So you've got a fundamental reason with the ability for production. And then the other side of it being the tariffs, on imports. So, we've seen $5.20, $5.30 for copper. So that's just one. I think the ETFs is where new investors, younger investors, are not wanting to focus on doing their homework on individual companies. So just like they're buying ETFs, for Bitcoin or for AI or for, anything that they're interested in, the easy way to nibble if you're a newbie investor and not someone who's used to doing homework on individual companies, buy the XLE from the point of view of getting your foot in the door on energy.
What are your thoughts on something like XOP playing the smaller companies or OIH for the energy services? We haven't really talked about the drillers and the pipeline companies. Any thoughts on those sectors?
Well, the drillers haven't really done well because, the rig count in the States is, as I said, it's down 5. Well, it's 5% down from, week to 593 rigs down from 624. and both the oil and the gas rig counts in the States are below a year ago. Again, so it just says to you that $70 oil does not attract more money. So, Trump's drill, baby, drill, and let's get lower oil prices. The industry is not reacting to that. In fact, they're saying, oops, we're not spending money if we can't make a good rate of return. So they're waiting for the regulations to change in the States. And if the economics make sense, they'll do it. But I don't see companies spending more than cash flow anymore, because shareholder returns are a big component of what boards have been forced to consider based on shareholder demand.
Oh, that's what we hear from all the companies we talk to in the energy space, is that investors want money returned to them, rightfully so, mostly in the form of dividends, although some are okay with share buybacks. Joseph, you mentioned that you can sit in some of these stocks right now with a 8, 9, 10% dividend yield. Care to share with us any of the names that you really like that are paying a higher dividend?
Yeah, I'll just pull up my pages for that. But on my last run, you were getting, from the service sector side, you were able to get like a 6% yield in Enbridge. And then on in royalty trust, you were able to get an 8.4% yield on a freehold. You were able to get a 7.8% yield on a wipe cap. Some of the international names like Africa Oil and Alvopetro, 10% yields are there. Pine Cliff, we just talked about, paying monthly dividends, 6 cents annually, 7.9% yield. Surge Energy was trading under 5. It's now a $6 name, but on $6, that's an 8.7% yield. So it was over 10% yield. And then you go to Inplay Oil, which is a name you guys know, doing the merger with some Obsidian assets in the Cardium, 18-cent annual dividend, monthly paid, 11.4% yield. Petrus Resources, another Cardium player, paying an 8.8% dividend yield. So there's some very attractive yields out there. And so the question is, do you make the decision based on market cap? Do you want to make the decision based on where their production is? Do you want oil? Do you want oil and natural gas, or just natural gas with liquids? So, investors have a lot to choose from. The service stocks have not reacted because of the weak drilling activity, especially in the U.S. Pricing for day rates for drilling rigs has gone down. Even the frackers are having problems with pricing. So until we get into the summer and maybe and the higher prices that I'm forecasting, I think the service sector will lag. But historically, the torque on service sector stocks is enormous. So, for example, if I pull out a couple of the names here, if you look at Ensign, it's 239 today. Its 52-week high was 352. The low is 205, so it's closer to the low. Precision Drilling was at 109.20 at the high. It's 67.72. The low for the year 62.16. So you can just see from that, how big the gap is between the high and the low.
What about the pipeline companies? Because they're part of the oil services, and there's such a focus on infrastructure and moving these fluids around. What about the pipeline companies?
Well, they've done very well. For example, Enbridge is 63.43. The high for the year 65.62. The low 45.39. So Enbridge, because of the yield, because of the rising dividend, it's gotten a lot of attraction. If you go to something like TransCanada, TRP, 69.44. The 52-week high, 70.97, the low 48.12. So they're all trading because of that consistent and growing dividend and liquidity. The yields have come down because people have chased those securities. And, of course, you compare that to what you can get in the bank, and it's double or triple that they pay in the bank, and you had a growing dividend. So you can see why retail and, institutional investors that need income are looking at the sector and bought them. They've had a good run. I wouldn't chase them here. But if there was any pullback and the yields went up, or the stock prices went closer to the 52-week low, then there'd be a reason to go back and add to those positions.
All right. So, Joseph, circling around to the one thing that you said is that not a whole lot of these companies are focused on growth right now, especially the oil producers. You mentioned one, Inplay Oil, that's going through a big transaction that really transformatively could change that company. Anything else out there, company-wise, on your radar that is or are companies showing growth or in the middle of transactions that we should be paying attention to?
Well, you know about the Varen, Whitecap deal, which increases the dividend for the Varen shareholders. Varen's popped beautifully on that. We've been fortunately investors in Varen. We'll be investors in Whitecap going forward. Inplay with the deal with Obsidian when it closes is accretive on a cash flow basis, strengthens their balance sheet. They financed it with equity and debt, and they see it as an accretive transformational deal for them. So I think there's names like that. And then you look at companies that sold assets and have assets now that they can grow. Paramount, they did the big deal for 3.3 billion with Ovintiv. They have now 800 million of cash on the balance sheet, 500 million worth of investment assets, and they're in a growth mode again. So, Paramount's 1854, the lowest 1433. But remember, you got at the high was 3306, but you got to remove $12, which was a shareholder return of capital, and then there was a $3 extra dividend. So you got $15 on that deal, and the company's so shareholders are really happy with that. And then they also now have a growth mode, and you're still going to have paid a 5-cent a month dividend or 60 cents. So that kind of name on any pullback is definitely something to consider.
All right, Joseph, thanks for going around the horn with us here. We covered a lot in the energy sector. Could be another buying opportunity coming up. I just find it interesting just how much these stocks have rebounded with the rebound in the oil price, even though oil's not even back to $70 a barrel. Natural gas has been carrying the load, but again, these stocks still being looked at, I think, favorably, very much so by investors. Again, Josef Schachter is the founder and editor of the Schachter Energy Report. You can click the link in the show notes on our website, on your podcast player, or on YouTube to learn more about Josef's letter. Everyone, thanks for tuning in to this weekend show. Please go back through our website, podcast, YouTube channel, and even subscribe to our new Substack, where you can see all of the more summaries of our interviews throughout the week and have them delivered to your email inbox. Joseph, thanks for taking time with us, everyone. Thanks for joining us. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.